Well, you've got to give the Germans points for honesty. First, the boss of Deutsche Bank, Josef Ackermann, declared that many banks in the EU would collapse if they had to book the sovereign bonds that they hold at their actual value. And then Germany's top man at the European Central Bank, Jürgen Stark, has quit, apparently because he couldn't stomach the ECB's policy of buying bonds from indebted nations. So while all this helped clarify things in Europe, it further frightened an already fearful market. So just how bad are things there? I spoke to Westpac Sydney-based Chief of Fixed Income Strategy, Russell Jones, who's visiting London at the moment. Well, Russell, you've been back in London for a few days. How are you finding the mood there?
Quite honestly, the mood amongst investors here is about as depressed as I've ever seen it. I've been doing this kind of job now for 25 years, and I've never encountered anything quite as catastrophic as some of the views which we're seeing here. It's not so much of when things are going to get better, but how much worse they can get. It really is pretty much unrelenting doom and gloom.
What specifically is the focus of all the doom and gloom?
Well, it's many and various, really, but I suppose top of the list at the moment is the problems which Europe's experiencing, the sovereign risk crisis, the associated banking crisis. But also on top of that, there's a lot of concerns about the direction of the US economy and an overwhelming fear that we're about to tip back into recession after what has been an extremely anemic recovery process. The feeling really is that we're in an environment which is ominously redolent of what Japan's experienced over the course of the last couple of decades. It's an environment where you could see all the major rich economies in the Northern Hemisphere suffering a similar sort of malaise to the Japanese economy.
We're just looking at the government bond market for a moment. Bond yields seem to be either predicting recession and deflation or default. That is to say, they're either really low yields in some countries and really high in others. Is that a fair assessment?
That's absolutely right. I mean, the core government bond markets like the United States, the UK, the German government bond market, and also the Australian government bond market are performing extremely well, and yields are at historically low levels. In fact, if you look at the US Treasury market as the world's major benchmark, we haven't had 10-year yields down at this kind of level since before the Second World War. So there is a flight to quality, if you like, a flight to those markets where there's the greatest level of liquidity, the greatest level of security. On the other hand, however, countries, not least those around the periphery of the Eurozone, are seeing their interest costs at exorbitantly high levels. And that reflects the fact that the market considers that there's a considerable risk of default in some of those economies right now.
And to what extent are the concerns specifically about the banks, and in particular the European banks?
Well, it's definitely one of the major considerations at the moment. I mean, banking sectors generally tend to be fragile for a long time after the sort of financial crisis that we've experienced. And particularly in Europe, that is very much the case at the moment. A lot of the European banks hold a lot of the government bonds which have been issued by some of the more, shall we say, struggling economies around the periphery of the Eurozone. They have a lot of those bonds on their balance sheets, and quite frankly, they're not going to get all the money back that they invested in them in the first place if those economies default, if those countries default. So there is a distinct fear about the banking sector in Europe at the moment. You may have seen latterly that the new head of the IMF, Christine Lagarde, suggested that we needed a major recapitalisation programme for the European banking sector. And I think that's probably true. These are banks, these are systems, financial systems, which are going to need more government support before they can really become healthy once again.
Yes, but that's the point, isn't it? I mean, the markets are in no mood to recapitalise these banks. So isn't it the case that the governments have to do it?
Absolutely right, yes. I think that governments are going to have to put their hands in their pockets. Central banks are going to have to continue to act in ways that really they find very uncomfortable. But the support's going to be necessary. The last thing that really the global economy needs now is a major banking crisis in the Eurozone or in Europe more generally. I mean, there really would be widespread negative connotations from that. That's the sort of shock to the system when things are very fragile as they are at the moment, that could really push us back into the sort of downturn that we experienced back in 2008 and 2009.
So do you think that this will result in a lot of nationalisation of banks?
It could possibly go that far in certain economies, yes, at least temporarily so.
So what's the thing you're most worried about, Russell?
Well, I think, front and centre is the Eurozone crisis. There really is a sense that policymakers are running to stand still at best at the moment. Frankly, the Eurozone was a half-baked project in the first place, and it needs to be fully baked and fully baked quickly. And that means, in short, some kind of, let's call it, collectivization of fiscal policy within the Eurozone. And that's a very, very painful prognosis, politically speaking. It's very difficult for governments such as the German government, the French government, to take the sort of decisions which are necessary to, if you like, hold the Eurozone together. But unless they do that, and unless they do it quickly, the fear is that this crisis really is going to run out of control. Just
finally, on Australia, there's obviously a lot of debate about the direction of interest rates here. What do you think?
Well, the first point I'd make is that Australia's always been an extremely good international citizen. And so if there is a continued deterioration in the global environment, I think that the Reserve Bank would certainly be willing to get involved in any coordinated approach to provide support to the global economy. But secondly, there are signs within the Australian economy latterly that it's really not performing in quite the way that the authorities thought it would or would like it to. And we've seen that with this pretty weak employment report, for example. So our feeling is that irrespective of what's going to go on in the global economy, there are growing reasons for the Reserve Bank to embrace a more accommodative approach to monetary policy in Australia.
You mean to cut rates?
Yes, absolutely.
Thanks for joining us, Russell.
Okay, pleasure.